We continue to digest reporting season, the number crunching really continuing. But I thought with having Harvey Norman such a disappointment yesterday in light of inflation, that we would take a bit of a dive into the retail sector. And James Gerrish from Shaw Partners and Market Matters was happy to play along. So, James, good morning to you. Just a simple thought on where this market is expected to head. I mean, I had a chat with your colleague Sean Hickman at Market Matters yesterday saying we could still see some pressure coming through on the broader market.
Yeah, good morning to you, Nadine. Well, it was a soggy February after a pretty strong January. So obviously here we gave back nearly 3% in price terms for the index. Over in the US, the S&P was down 2.5%. So you think about what's driving that. It's obviously bond yields. Bond yields are testing multi-year highs, particularly the short end of the US yield curve. So that's put pressure on equities. So that could continue. It looks to me like equities are starting to, some of this selling pressure is starting to subside. We're starting to see some buying into weakness, particularly of companies that miss results. We touched on Harvey Norman yesterday that reported pretty poor numbers, but the stock was down a long way early on. It saw some buying late in the day. You talked to Adbri just before, and it's down again today. They have been universally downgraded from brokers this morning. The same is true with Harvey Norman, that no doubt we'll get onto.
Yeah, okay. Well, let's go into Harvey Norman because I read a note from UBS yesterday talking about the potential to lose further market share. It missed on earnings. There's a lot to the business. I mean, it's not just furniture, as you well know, but it's property as well. So when you take a look at Harvey Norman, is there a price that you would pay for the business?
There's always a price you'd pay for a stock. I think the trends that we saw in Harvey Norman are playing out across the broader retail space. So retail sales are not, they're not all the same. So those big ticket items are struggling. The lounges, the furniture items, the white goods, etc. And we saw that through Harvey Norman's results yesterday. We saw it through Nick Scali's results. Earlier in the reporting season, we've seen some of those smaller ticket items continuing to sell pretty well. So super retail has a business that is a little bit of a mixed bag. There's a lot of smaller items that they sell across their network. You've seen when Wesfarmers reported consumers trading down, so into the Kmart division. The supermarkets have said the same thing, that they're trading down. So I think you've got to think about retail and not thinking about it all as sort of one collective thing. There's a lot of moving parts in the retail space. Harvey Norman's come on this morning and it's trading down another 1%. It's trading down at 381. So, I mean, sub $4 puts Harvey Norman on a 9 times PE. Obviously, you may mention the property assets, etc. But the underlying earnings yesterday, stripping out the property side, were miss consensus by about 10%. So to me, the momentum is on the downside in Harvey Norman. I'd stay away from the retailers that sell big ticket items and focus on some of the ones that sell the more the smaller items, or allow consumers to trade down across their product suite.
So you did sort of name drop Nick Scali there. Do you see any difference between a Nick Scali and a Harvey Norman when it comes to the likelihood to be able to navigate what will be a very difficult consumer environment, no doubt?
It will be a really difficult consumer environment, particularly the products they're selling. So in that sort of environment, you want to back management expertise. So the Scalis are great retailers. So you think about Harvey Norman and how that operates from the franchise sort of business. I'd be backing Nick Scali I think it's trading on a valuation very similar to Harvey Norman as well. Obviously, it doesn't have the huge amount of property assets on their balance sheet, but they're a better retailer. They've got a better niche area of the market they operate in. So to me, I'd be backing the quality management teams, and to me, I'd be buying Nick Scali over and above Harvey Norman, given where both of the share prices have been under pressure. Harvey Norman more so than Nick Scali, but Nick Scali is still down 25% from its recent highs. So there's certainly value there, Nadine.
Okay, let's go to a different type of retailer altogether, and ignoring this sort of conglomerate nature of Wesfarmers, I guess, if we're talking retail. Wesfarmers, I note that Citi said in the wake of its result, which did come in above consensus, that it fails to see why Bunnings isn't seeing margins increase, why it's not passing on supplier cost increases given its position as market leader, because it did see its margins continue to come under pressure. That's an interesting point.
It is a really interesting point. It's one of the sort of the variances when you look at the Wesfarmers results. So there are some parts of the business that were doing particularly well. So the fertilizer, chemicals business, etc., that was a really big support for Wesfarmers. In the retail division, the Bunnings sales numbers were strong, but you did make mention of margins, which were a little bit on the lighter side. Obviously, cost pressures playing into that. But then you look at the Kmart part of the market, part of their operation, which was really strong. And that supported it, but also Officeworks and a few other things were on the weaker side. So a mixed bag, but overall they were strong in terms of earnings at the group level. So it means that margins have been strong at the group level. So I would suggest that they're doing that to maintain top line earnings growth. So as more of a focus for the Bunnings division, they've just introduced yesterday they made the announcement around going harder in the pet side of things, and I know how much we spend on our dog, so that's probably a good move in terms of the Bunnings business there. But it's a really interesting business. It's continuing to grow. It's now such a dominant part of the Wesfarmers brand. So I think operationally they're doing fantastically well. They've got a great balance sheet and they're going to take advantage of any downturn in retail. I get that there's some concern around why they're not improving margins, but that probably speaks to where the stock's trading at the moment and why it's not trading sort of in the mid 50s and it's trading around the $48 mark, Nadine.
Super Retail you mentioned as well. So it pre-guided the market. They were strong results. Still a cautious consumer, and they've got to cycle some pretty strong comps when you think of Omicron, when you think of flooding, So is there reason to be cautious about Super Retail as well, because its share price has also been doing well?
Yeah, really, really strong momentum in Super Retail. They've done particularly well in the last couple of months in terms of their share price, and that's reflective of how the business is going. It speaks to how consumers are shopping. They're buying those the smaller items. They're not having an issue buying the smaller ticket items, but it's the large ticket items that are struggling. I note the CEO has just sold 87,000 shares, just announced to the market a few minutes ago. So that stock could come under pressure today. That's obviously never a positive in terms of CEOs selling down stock for whatever reason they give. So something to watch today. But Super Retail, it's got momentum. I'd be reluctant to go out there and buy it at this point in time. It's trading sort of $12.82 right at this point in time. So it's had a good run. I'd be more patient buying weakness in retailers because I think it's going to play out one way or the other.
Now, final, and I know I'm sort of testing the friendship here, but Retail Food Group. So this has been touted by many small cap, advisors as a real turnaround story, one that still has a lot of upside left in it. What's your view?
Yeah, we like it. It's as I was saying around the dynamics playing out in retail sales, that these spending on cafes and all of the things that Retail Food Group have, donuts and the like, that's continuing to be very well supported, as we've seen in the composition of the retail sales data that's out recently. So, the turnaround here has been, it's played out to a large degree. It's rallied from 4 cents up to 11 cents. It's back at 9.2 cents or thereabouts on the market today. So a lot of that, optimism has been built in the share price. So I'd caution that viewers are being told about this stock after it has doubled in share price. So just keeping that in the back of the minds. But it's got a good turnaround story. It's had some regulatory